So one of the most common questions I get from viewers of the channel is, how do I trade earnings? What are the right way to trade some of these earnings plays? Right now, we're coming into some of the big tech stocks reporting earnings. As I'm recording this video today, I'm not sure when this video will come out, but later today, Google is going to report earnings, and I'm actually going to show you guys exactly how I would trade something like Google or whatever stock it happens to be that happens to be reporting earnings. So let me go ahead and go to the Google options chain here. Now, if I take a look at the stock chart, because obviously you want to know where Google is trading, what's its recent range? Right now, I would say Google is very near its recent lows. It's well off its recent highs. So if you wanted to pick a directional assumption, then I think the only directional assumption that's really correct here is to be bullish, but that's me. Not that I know anything. If you want to be bearish, hey, you be bearish. But typically the way I do trades, I have a default position as far as if I really don't have a directional assumption. And I would say 80%, 90% of the time I don't have a directional assumption, especially if I'm trading stocks that I don't regularly follow. Now, Google, a major player in the stock market, I actually follow a lot of Google, what it does. I trade Google often. So I do have some opinions on a stock like Google, but if it's a stock I have absolutely no directional assumption whatsoever, then my default is to always go out about 60 days. So in this case, I would go to 57 days, this June monthly cycle, and I would sell a strangle. Now for earnings, I like to go a little further out of the money just to be safe. So somewhere I would say in the 10 to 15 delta range on each side. So in this case, to be extra safe, I'm going to go to the 10 delta put, and then on the call side, I would do the 10 delta call. So I would sell the 130 put, the 190 call. I'm well out of the money, $30 out of the money on each side. Google would have to make a massive move. And the reason I go out 60 days is because with more time on the trade, with 2 months on the trade, you can get really far out of the money, right? And these options still pay a decent credit because the further out in time, the more expensive an option is. That's why if I'm going to sell options, I go further out in time. If I'm going to buy options, I'm going to do a very short dated trade for that. So in this case, if I'm looking to sell a strangle, I'm going to go about 60 days and I'm going to go somewhere between 10 and 15 deltas on each side of the trade. So this is what I do if I don't have any directional assumption. I'm just trying to profit from Google, hopefully not making a big move in either direction and volatility collapsing tomorrow, because once earnings are over, this really high IV that Google currently has is going to come down. And what do short options really like? Well, they like volatility to decrease, and you're going to profit from that. So even though I'm putting this on at 57 DTE, if I get a really big volatility collapse and Google doesn't make a big move in either direction, it's going to move, but as long as it doesn't make a drastic move in either direction and I get that vol collapse, I will make a little bit of money. I could even make 50% profit, in a day, in the one day, even though it's a 57-day trade, I'm still going out, 57 days, partly because, again, I want to be as far out of the money on these as possible should something go wrong. Plus, the more time you have on the trade, let's say Google makes a $50 move down or a $50 move up. It's going to blow past, my short put or my short call, and then I'm in real trouble. If it's a one-day trade, I'm in real trouble. If it's a 57-day trade, I've got a little time. I've got 2 months to wait it out, and hopefully it'll come back to me, or I could defend the trade, start rolling the calls down or the puts up, depending on what I need to do. So that's why, on my default trades, if I don't have a directional assumption, 60 DTE, and I do the strangle, if it's a high price stock that I want to define my risk, maybe I can't do a naked strangle, it's just too big of a stock, then I'll do something like an iron condor. Typically on the iron condor, you'll have to bring it in a little bit. And I would do something like, in this case, the 19 delta short put, 19 delta short call, and then buy the long wings on the outside. In this case, I'll go $5 wide. I will get about 142 credit max loss 358 on this iron condor. I've defined my risk, and just like the strangle, as long as Google doesn't move very much tomorrow on earnings, and as long as volatility also comes in quite a bit, I'll make a little money, possibly a little money in as little as 1 day. Now, the iron condors typically take a little longer to work out than a strangle. So, it would be rare for this to end up being like me making 50% in 1 day, but I might be in it a couple of weeks or whatever, but this is a defined risk trade, very small, very safe trade. So that's what I do if I don't have a directional assumption. But let's say I follow Google all the time, and you know what? I think Google is way oversold. Google cannot go down on earnings, in my opinion. Let's just say that's my opinion. I think Google has to go up. So I have a directional assumption. So if I have a directional assumption, typically I want to do something like buy a long call, or buy a call debit spread, or buy a long call butterfly. I'm buying some options, and buying options is very expensive in a 60-day cycle, right? Because these options are rich. That's why we sell them way out in time. If I want to buy options, I want something much cheaper. So I'm going to go, in this case, to the 1-day cycle, which is perfect for an earnings trade because you're only typically going to be in it 1 day anyway. So this is where, if I'm really strong as far as my directional assumption, if I'm bullish, I'm just going to buy the at-the-money call. Or if I'm bearish, I'm going to buy the at-the-money put. Now, you may not want to buy these at-the-money calls or puts because they're kind of expensive. If you want something a little cheaper and you really think Google is going to move in a big way, you can move these out of the money and you pay a lot less. But the downside is you need a real move for these to work out. In this case, this out of the money call. Or on the downside, the put, I could move it out of the money. Instead of paying $400 for the at the money put, pay $150 for this out of the money put, right? So this is much less probability of me actually winning on the trade, but again, I'm paying a lot less for the out of the money options. And if you're dealing with a really high price stock where just buying naked options is just not a possibility, you can do spreads. Instead of just buying a call, you can buy a call debit spread. In this case, the at the money call debit spread. You're essentially risking one to make one. It's a 50-50 coin flip. Very similar to buying shares of stock, but buying shares of stock is very expensive and it would be a big position, especially if you buy like 100 shares of stock, a one lot. In this case, I can make this a really tiny trade. For example, in this example, I'm essentially buying the spread for $125. If I win, I make $125. If I lose the $125 I paid for the spread, right? So it's perfect 1-to-1, risk reward, and it's a 50-50 shot. And of course, I could do that on the opposite side. If I wanted to do this with the puts, I could do this on the put side as well. Buy the put and then sell the one below. And again, we're risking one to make one, and you've got about a 50-50 coin flip shot on that. Now, if the debit spreads are even too expensive for you to make these even cheaper, so let's go do the call debit spread again. What you could do, just like you did with the naked calls, you can move these out of the money to make them even cheaper. For example, I could buy this way out of the money call debit spread. I'm only going to pay $48 for this spread for the potential to make $200. So I'm risking one to make four, right? It's a lottery ticket kind of play though. The odds of this working out are not very good, but I'm not spending very much. It's a very cheap lottery ticket kind of play. And of course, you can do this on the other side too with the put debit spread. You can move it out of the money to make it really cheap. You can size it however you want to size it. I can make this $3.50 wide here, for example. I'm going to pay $91 for this out of the money put debit spread. But if I win $259. So very high reward, low risk. Now, when you get trades that are high reward, low risk, they're typically very low probability trades too. So you can see probability of profit is only 28%. So the odds of this working out, about 3-to-1 against you. So that is what it is on that. One other thing I will often do if I can do a 1-day trade, which typically if something's reporting earnings on a Thursday, which Google happens to be reporting on a Thursday, which means Friday expiration is tomorrow. So if it's exactly a 1-day trade, one of the things I really love are butterflies. So a butterfly is, typically, I plan for a move up or down. In this case, let's say I'm bullish on Google. I'm going to go to the expected move up. So this ruler here on TASTYTRADE tells you this is the expected range, the range that Google is expected to trade in 68% of the time by the end of the day tomorrow. Typically, I go right to the edge of that and I will sell this call, and then I will go, let's go $5 wide in this example, and I will buy some wings, and then the short call, in this case, I need to double it up. So you've got two short calls in the center, and then the wings, the long calls, $5 wide on each side. This is a long call butterfly spread. If I take a look at the risk profile of this, let me show you what this looks like. This is a long call butterfly. Let me zoom out so you can really see what this looks like. So Google is currently trading right here. If tomorrow I get the up move that I need, we will trade into this tent area. And if I go forward a day on my analysis here, go forward tomorrow, if we're trading here, say in the morning, I'm going to profit somewhere around $140, $150, and that's early in the day. Later in the day, we start creeping up to potentially the max profit right here at the peak of $427 is the max possible profit, but you're not really going to get that unless you hold all the way to expiration and let it expire, and it expires exactly at your two short strikes. That's not something you probably want to do. Plus, you could end up facing exercise or assignment on some options because you're going to finish in between some of these spreads. So typically, you don't want to hold it all the way to expiration. But this is something that, hey, if I get the move right in the morning, I'm going to pocket probably about $100 to $150. And if I'm wrong, well, in this case, the spread, I only paid $73 debit to buy this $5 wide butterfly spread. So it's a really cheap trade. With a max profit of $427, typically you're not going to get all of that. At best case scenario, you're probably getting half or less, again, unless you're holding it very late into the day, and typically you're probably going to get out before then. And I would do the same thing on the downside. Again, if I was bearish in Google, again, we stick to the one-day cycle because we're buying a butterfly spread. So to make it cheaper, we want to keep the option cycle very close, short dated. So in this case, I would go right to the outside of the expected move to the downside. I'm going to go ahead and sell that put, and then we'll go $5 wide again on each side, and then make sure to double up the short puts in the middle. And this is our long put butterfly spread. And in this case, we're going to the downside, right? So right now we're trading here, but if tomorrow Google trades into the butterfly spread, I'm going to profit about $160 or so. And in this case, I'm paying $65 debit for this particular spread, max profit of $435. And of course, $435, you only realize that at expiration if you hold all the way to expiration, and we finish exactly at the 150 short put strike price. So lots of ways to be directional on these earnings trades. If you have a strong directional assumption, you've got long calls, long puts, long call spreads, long put spreads, long call butterflies, long put butterflies. You just pick and choose what's appropriate for you as far as probability of profit and also just the size of the trade, how much you want to spend on those options. Now, I would say, again, 80% of the time or more, I do not have a directional assumption. That's why, if I don't have a directional assumption, I go to the 60-day cycle and I sell a strangle if I can afford it, or I define my risk and sell an iron condor. So, and I would suggest you do that most of the time. If you're one of these people that you always have a directional assumption, you think you can pick direction, trust me, you're wrong. In this case, like with Google, I was being honest. If I had to play Google, I would play it to the upside because why not, right? And I have a reason. I'm not just guessing. This is not a wild ass guess, right? Google is near its recent all-time lows as far as like on a yearly chart. So I would never go buy puts. I just don't think there's enough reward on it, right? What's Google going to go? It might go down, but is it going to go down in a big way? It's just not. The risk versus reward is just not there. If you really want something that has the potential to really reward you, I think you have to buy calls. And again, that's not me necessarily being positive on direction as far as I know it's going to go up. But if it's going to make a big move, it's much more likely to be on the call side. So I might as well buy the calls, right? It's one of those things. Hey, if I'm going to potentially make a large reward on this, that's the right way to play it. So there you have it. Some of my thoughts on how I trade earnings. Those of you that follow me in the DT Options Discord channel, you guys see me do these earnings trades all the time. Typically the 60-day strangles, very common trade. If I'm being directional, I always go into the shortest dated weekly cycle. Buy calls, buy puts, buy call debit spreads, buy put debit spreads. If you want to learn more about how to trade options, and especially my favorite option strategy, which is the wheel option strategy, check out my book, The Super Wheel Option Strategy. This book, it's available over on Amazon. You'll find a link to the book in the description below. Peace, guys.